Hello and welcome to this week's edition of the Echo45 Advisors Market and Economic Update. My name is James Sutton, Director of Portfolio Management and Technology, and I'm filling in for John this week. In this video, we'll discuss the hidden costs of holding too much cash and why holding the right mix of assets remains crucial for long-term financial success. What's changed recently is that short-term interest rates are falling as the Fed cuts rates again. Unlike stocks and bonds, the yield we earn on cash can change quickly as financial markets shift. In the next few minutes, we'll discuss both the importance of cash and why holding more cash than appropriate, which we often refer to as, quote, excess cash, can be a challenge. Let's start by looking at the long-term performance of stocks and bonds compared to inflation. The history of financial markets tells a clear story. Stocks and bonds have far outpaced inflation. This is true despite periodic market pullbacks, financial crises, and recessions over the past century. While past performance doesn't guarantee future results, the compounding effect of even modest returns above inflation can create wealth. Now, let's be clear about when cash makes sense. From a financial planning perspective, cash provides essential liquidity for expenses. For example, a down payment for an upcoming home purchase should be in cash, as should tuition payments and other bills due within the next year. Similarly, maintaining an emergency fund provides crucial protection against unexpected events. The problem occurs when investors hold more cash than needed for these practical purposes. There are hidden costs to excess cash. The first hidden cost relates to how short-term interest rates work. While money market funds and savings accounts may appear attractive, these rates aren't locked in for the long term. They're variable and subject to change. This creates what's known as reinvestment risk. If rates fall, investors need to decide whether to accept lower yields or switch back to longer-term investments, potentially missing out on returns in the meantime. The second hidden cost is inflation. Even when savings accounts offer attractive rates at the start, they often don't keep pace with the rising cost of goods and services year after year. In fact, the real inflation adjusted income on cash has been negative throughout most of the past 2 decades. Cash feels safe because account balances appear stable. However, what we can purchase with our money is ultimately what determines financial security, not the dollar amount we see in a statement. Let's now look at the broader market picture. Money market fund assets have reached near record levels of $7.3 trillion. However, as rates have begun to decline, these excess cash holdings could face reinvestment challenges. This is often referred to as, quote, cash on the sidelines, reflecting the possibility that some investors may move back to stock and bond investments over time. So while cash serves important purposes, holding excess cash creates hidden costs. For long-term investors, maintaining an appropriate cash buffer while staying invested remains the best approach to achieving financial goals. We hope you found these insights helpful. If you'd like to discuss your cash allocation or any of these topics in more detail, please don't hesitate to reach out to us. We look forward to speaking with you. Have a great week.